On November 18, 2025, global financial markets were gripped by anxiety, as investors around the world watched in disbelief. The mood on Wall Street was tense, with traders and analysts glued to their screens, tracking every tick of the market. Headlines flashed warnings of a major downturn, and the sense of unease was palpable, not just in New York but in financial centers across the globe. The uncertainty quickly sent Wall Street into a sharp decline, as sell orders flooded the market and prices tumbled in rapid succession. The atmosphere on the trading floor shifted from nervous anticipation to outright alarm. This marked the fourth straight day of losses for U.S. stocks, a streak not seen in months. The sell-off was broad, hitting both tech giants and traditional companies alike, as investors scrambled to reassess their positions. Even the most stable blue-chip stocks were not immune to the wave of selling. The Dow Jones fell nearly 500 points, erasing weeks of hard-earned gains in a matter of hours. The sudden drop left many wondering if this was just the beginning of a deeper correction. Meanwhile, the S&P 500 and Nasdaq dropped 0.8% and 1.2% respectively, deepening the sense of crisis. The losses rippled through portfolios, retirement accounts, and investment funds, sparking concern among everyday investors and professionals alike. The epicenter of the turmoil was the tech-heavy Nasdaq, which was dragged down by a steep sell-off in semiconductor stocks, the backbone of the AI revolution. These companies, once seen as unstoppable, suddenly looked vulnerable as their valuations came under intense scrutiny. Investors who had been so optimistic about AI's promise and the future of technology suddenly questioned if the boom had gone too far, too fast. Doubts spread quickly, and confidence evaporated almost overnight. The fear was clear: AI valuations had become detached from reality, and a painful correction was now underway. The rapid rise in prices had left little room for error, and now the market was paying the price. As losses mounted, panic selling set in, creating a self-reinforcing cycle of fear and uncertainty. Each new drop in prices triggered more selling, as investors rushed to cut their losses before things got worse. The day ended with deep uncertainty and a sense of vulnerability, as the market confronted the risks of its own exuberance. Investors were left to wonder what would come next, and whether the worst was yet to come. So, what is the AI bubble everyone's worried about? The term has been popping up everywhere, from financial news to tech podcasts, and it's sparking heated debates among investors, business leaders, and everyday people alike. Picture a balloon stretched to its absolute limit. An AI bubble forms when hype, excitement, and wild speculation drive company valuations far beyond their real profits or business fundamentals. It's when the promise of future breakthroughs overshadows the reality of what's actually being delivered today. Today, some AI firms are valued in the trillions, despite having only modest revenues, or, in some cases, no profits at all. Investors are pouring money into these companies, betting big on the next technological revolution, even if the numbers don't always add up. Companies are taking on massive debt to build out AI infrastructure. Think sprawling data centers and supercomputers, echoing past bubbles where excitement and optimism outpaced caution and careful analysis. The race to dominate AI is leading to risky financial decisions. A recent survey showed that 45% of fund managers now see an AI bubble as the market's single biggest risk. That's nearly half of the professionals who manage billions in investments, sounding the alarm. The fear is simple. If AI investments don't deliver real profits soon, investor faith could evaporate overnight. That could trigger a mass sell-off, sending shockwaves through the entire market and potentially causing a broader financial crisis. This scenario draws uncomfortable parallels to the dot-com bust of 2000, when sky-high expectations for internet companies ended in disaster for many. If the bubble pops, the fallout could be severe, impacting everyone from giant institutions and pension funds to individual savers and families worried about their financial future. The effects could ripple through the economy, touching lives far beyond Silicon Valley. History, it seems, could be repeating itself. But this time, AI is at the center of the storm, and the world is watching closely to see what happens next. The AI bubble fears hit hardest among tech titans, especially Nvidia, the face of the AI revolution. Nvidia's GPUs are essential for AI, and its stock soared over 230% in a year, reaching a $5 trillion valuation. But on November 18th, even Nvidia stumbled, as investors questioned whether its growth could justify such lofty prices. The sell-off in Nvidia signaled deeper worries about the entire AI sector's sustainability. Analysts also raised concerns about circular financing, where Nvidia helps finance customers' chip purchases, fueling growth with debt. This echoes risky financial practices from past crises. The market's heavy reliance on a handful of tech giants, the Magnificent Seven, means a stumble in AI stocks drags down the whole market. When these leaders falter, the impact is outsized. The lack of diversification leaves the market exposed to shocks from the AI sector. The market's pain wasn't limited to tech. Old economy stalwarts like Home Depot also took a hit. As Wall Street braced for more volatility, even the most established names weren't immune to the growing uncertainty rippling through the economy. Home Depot's stock plunged 6%, its worst day in years, after the company issued a profit warning and cut its outlook. The sudden drop sent shockwaves through the market, as investors realized that the slowdown wasn't just a tech story, it was spreading to the heart of American retail. The reason? A deepening slowdown in home improvement spending, a key indicator of consumer confidence. Fewer shoppers were filling their carts, and the once busy aisles now echoed with uncertainty about the future. Higher borrowing costs and persistent inflation are squeezing household budgets, making big projects less affordable. Families are putting off renovations, and even small upgrades are being reconsidered as every dollar counts. Home Depot's warning suggested the slowdown is more than a blip, it's a sign of broader economic stress. The company's cautious tone hinted at deeper issues lurking beneath the surface, raising red flags for analysts and consumers alike. The news rattled the retail sector and raised doubts about the strength of the U.S. economy. If a giant like Home Depot is feeling the pinch, what does that mean for smaller businesses and the millions of workers they employ? With tech stocks shaky and consumer spending weakening, investors faced a double threat. The pillars of the market, growth and stability, both seemed to be crumbling at once, leaving few safe havens. The timing couldn't have been worse, compounding market fears. Headlines blared warnings, and the sense of unease grew as investors scrambled to make sense of the shifting landscape. The question? If both high-growth tech and stable consumer sectors are under pressure, where can investors find safety? Traditional safe havens like gold and government bonds saw renewed interest, but even these options felt uncertain in such a turbulent environment. The answer, for now, remains elusive. As the dust settles, investors and consumers alike are left searching for clarity in a market that seems to offer none. The semiconductor sector, the backbone of AI, suffered a brutal sell-off. The PHLX semiconductor index fell into correction territory, down over 10% from recent highs. Major chipmakers like AMD, Marvell and Micron all saw sharp declines, not just Nvidia. Investors fear the AI gold rush has led to over-ordering of chips, risking a glut and a sudden drop in demand. The chip industry is notoriously cyclical, with booms often followed by painful busts. The market is now pricing in the risk that the peak of AI-driven chip demand may have already passed. Seasoned investors see warning signs of another downturn. The synchronized drop across chip stocks signals skepticism about the entire semiconductor ecosystem. The foundation of the AI boom is suddenly looking shaky. Wall Street's anxiety quickly spread worldwide, turning local fears into a global sell-off. Asian markets were first to react. Japan's Nikkei and South Korea's Kospi both plunged over 3%, led by tech giants like Samsung and SoftBank. As Europe opened, major indices like the FTSE 100, CAC 40, and DAX all dropped at least 1%. European tech and luxury firms, sensitive to U.S. trends, felt the pain as global investors fled risk. The synchronized declines showed no market was immune. The U.S. tech sector's central role in global finance means its troubles ripple everywhere. When American AI leaders stumble, confidence falters worldwide. International investors, spooked by U.S. volatility, sold off assets across the board. November 18th proved how interconnected and fragile the global financial system has become. A bubble in Silicon Valley can trigger a fever around the world. Beyond falling stock indices, other warning signs flashed red on November 18th. The VIX, Wall Street's fear gauge, jumped 7%, signaling rising anxiety. Investors rushed into U.S. Treasury bonds, pushing yields down as they sought safety. The benchmark 10-year Treasury yield dipped to 4.112%, confirming a classic flight from risk. Even Bitcoin wasn't spared, briefly dropping below $90,000 before rebounding, showing that panic reached even speculative assets. When fear takes hold, investors sell their riskiest holdings first. These moves painted a picture of a market in full retreat. Rising volatility, falling yields, and crypto turmoil all pointed to deep unease. Analysts watch for these correlated moves. They often signal more trouble ahead. The tea leaves were clear. The market was bracing for turbulence. Just as the market closed on a sour note, Nvidia delivered a surprise. Its third-quarter earnings shattered expectations, $57 billion in revenue, up 62% year-over-year. The data center division led the charge, confirming robust demand for AI hardware. Profits soared, and Nvidia's outlook remained bullish, with leadership dismissing bubble fears. CEO Jensen Huang insisted the AI boom was just beginning, not ending. Investors breathed a sigh of relief. Nvidia's stock jumped 4% after hours, lifting other chipmakers too. While one report can't erase all fears, it reminded the market that real profits are fueling the AI surge. For now, the AI engine is still running hot. Despite Nvidia's strong results, market nerves remain. The tension, explosive AI growth versus fears of overvaluation and economic weakness. Investors are on edge, torn between chasing gains and avoiding a crash. All eyes are on upcoming economic data, especially jobs reports, for signs of broader trouble. Company earnings, especially from rivals like Lowe's, will be scrutinized for clues about consumer health. The market stands at a crossroads, with bulls and bears locked in battle. Memories of past bubbles linger, urging caution. The AI revolution story is far from over, but the market is finally asking the hard questions.